Well, welcome back to the Undervalued Investor YouTube channel, where today we're analyzing 3 stocks after earnings. We're going to talk about NVIDIA's blowout quarter. We'll talk about Amazon and how the e-commerce space has been performing. And then finally, Toronto-Dominion Bank to see how the higher interest rate environment has been affecting some of these major banks in Canada. If that is a conversation you'd appreciate, hit that like button and consider subscribing for future stock videos just like this one. Getting into it, first and foremost, NVIDIA stock has absolutely been the darling child of the entire market this year, trading up 226%. And from its all-time high of 2021 is just blown past it, trading up 41%. Very impressive after the numbers they posted wildly beat out analyst expectations. You know, they posted $13.5 billion quarter over quarter. That's up 88%, and year over year up a whopping 101%. But what makes NVIDIA so intriguing about this AI, this cloud computing, chip maker that everyone from Amazon is buying. I mean, we've seen Google, Meta, they're all buying their chips, and these gross margins are bigger than pretty much any of the large tech companies. They posted gross margins of 70%, which have increased dramatically over last year. And taking a look at it from a quarter over quarter basis from the revenue chart, these numbers were absolutely astounding. Everyone is claiming there's an AI bubble, but for as long as NVIDIA is able to post these kind of numbers, this stock will continue to trade at a wicked multiple, which right now I think its price to earnings is sitting at around 112. But continuing on, Amazon, taking a look at the stock trading up 54% year to date, it has not been able to peak its all-time highs, which is kind of impressive for the numbers they have been posting, still trading down about 27%. Amazon has proven that even in this kind of tougher macro environment, that there's still huge growth for the e-commerce sector. The e-commerce hasn't fully saturated the market yet as people, continue to shift from traditional brick and mortar into the realm of online shopping. As we can see, their net product sales went from 113 billion to 116 billion, and their net services went from 124 billion to 145 billion, giving them a net total of 261 billion for the first half of 2023, which is pretty astounding. We're talking some very good growth here, and a lot of this has also been driven by their cloud computing business. Cloud has been one of the fastest growing drivers for all these tech companies. And again, as mentioned, even Amazon is purchasing some of these high-end chips from NVIDIA. And taking a look at their consistent quarter over quarter, we can see that in the lower interest rate environment we had from 2010 to 2020, where things were very fluid and consistent, this company was growing at wicked paces of anywhere from 20 to 30, 40, upwards of almost 50%, especially when they had the helicopter money that was printed from the Federal Reserve. And now we're going into this nominal higher interest rate environment where they're not able to grow at these wicked fast paces like it was, but 10% growth on a company that's generating, $500 billion, that is still absolutely ridiculous. I mean, you're talking about over $50 billion over annual growth. I mean, that's pretty incredible on an annual basis, right? But Toronto Dominion Bank, kind of coming in here for our third stock to analyze for you dividend lovers out there with a 4.67% yield. It's trading up it's almost given up its 5-year returns, and year to date has been trading down about 6%. This one has continually gotten bad news ever since they couldn't close on the First Horizon deal in the US, which would have made them the 10th largest US bank, but trading for $150 billion is the second largest company in Canada. And for dividend lovers, what you should notice is that the dividend yield hovering around where it is at about 4.7 is actually the highest dividend yield it is had ever, basically over a 20-year period, with the exception of the pandemic. So to be locking in these yields on a company that has currently a payout ratio of somewhere around 50% could yield some really great returns just from the dividends alone. This is a company that's taken the dividend from 39 cents 10 years ago to today where it's at 96 cents. And they've also announced share buybacks. Because of that large deal that didn't close, they have billions of dollars in cash on the balance sheet they can expend. And they also recognize their stock is trading at a discounted value, so they're going to put some money in there as well. And taking a look at the revenue front, this is a company that's continually seeing crazy revenue growth, primarily just based off the higher interest rate environment. Obviously, when interest rates go up, people are paying more on their mortgages, their line of credits, and that benefits the bank over long periods of time because the total revenue sits at 12.7 billion versus this time last year where it was only at 10.9 billion. On the 9-month ending, 37 billion versus 33 billion, and all of their net income right now is being eaten up by loan loss provisions. They put 766 million aside versus 351 million this time last year. And loan loss provisions just have to go up as loans become less credit qualityed. Obviously, as interest rates go up, people have to make more payments. They're losing credit quality on a lot of the debt and the mortgages. So they have to put this aside in case people start to default. And this is one of those companies where, so long as you don't believe the entire economy is going to collapse, we do have a potential for a soft landing. Inevitably, in this higher interest rate environment, when they stop putting loan loss provisions provisions aside, that's going to hit the bottom line, and they're going to be able to start printing money. So this is something I would keep an eye on for sure. It's a stock that I have been personally buying, but all of these companies are very intriguing for their own reason. And I'll pass that question off to you. I'd love to know what you think in that comment section below.